Alright, let's dive into something that's been buzzing in the financial world lately, the shifting landscape of alternative investments, or alts as the cool kids call them. And no, I'm not talking about NFTs or meme stocks. This is about the real deal, private equity, real estate, private credit, and more. But here's the kicker, while advisors are still all in on alts, the how and why are changing in some pretty fascinating ways. Let me break it down for you. First off, the big picture, 89% of advisors are either sticking with or ramping up their alts allocations. That's huge. But what's really interesting is the shift in sentiment. Last year, only 14% of advisors said they'd increase allocations. This year, it's up to 39%. Personally, I think this reflects a growing confidence in alts as a core part of portfolio diversification, especially in a market that's been, let's say, unpredictable. But here's the flip side, the percentage of advisors planning to cut back has also doubled, from 5% to 11%. What does that tell us? Maybe that alts aren't a one-size-fits-all solution, and some advisors are hitting pause to reassess. Now, let's talk tech. Because, let's be honest, technology is the unsung hero of this story. Risk and performance analytics tools are now the top priority for advisors, with 51% saying they're critical. What makes this really interesting is that it's a jump from 43% last year. In my opinion, this shift highlights a bigger trend. Advisors are getting smarter about how they manage risk in alts. It's not just about access anymore. It's about understanding what you're getting into. Meanwhile, things like automated subscription processing and CRM integration, they've taken a backseat. From my perspective, this suggests that advisors are prioritizing substance over convenience, which is a healthy sign for the industry. But here's where it gets tricky. The biggest challenge advisors face: assessing liquidity and risk exposure across asset classes. Nearly 60% of them flagged this as a major issue. What many people don't realize is that alts are inherently less liquid than traditional investments, and that complexity can be a double-edged sword. On one hand, it offers higher potential returns. On the other, it requires a level of expertise that not all advisors, or their clients, are comfortable with. This raises a deeper question. As alts become more mainstream, how do we bridge that knowledge gap? Speaking of clients, one detail I find fascinating is that explaining alts to clients is the biggest barrier to usage, according to 17% of advisors. If you take a step back and think about it, this isn't just a communication issue, it's a trust issue. Clients need to understand what they're investing in, especially when it's something as complex as private equity or hedge funds. What this really suggests is that education isn't just a nice-to-have, it's a must-have if alts are going to keep growing. Now, let's talk asset classes. Private equity is still king, with 64% of advisors eyeing it for their clients. But real estate is gaining ground, jumping to 50% from 44% last year. Personally, I think this reflects a broader shift toward tangible assets in an increasingly digital world. Meanwhile, private credit and hedge funds, they've taken a hit, dropping from 56% and 54% to 43% and 42%, respectively. What's going on there? My guess is that the recent redemption requests in non-traded BDCs and interval funds have made advisors a bit more cautious. And venture capital, it's surging, up to 37% from 26%. That's a trend I'm keeping my eye on, especially as tech and innovation continue to drive global markets. Finally, let's zoom out for a second. The enthusiasm for evergreen funds has cooled a bit, with only 63% of advisors expecting client exposure to exceed 10% in the next 2 years, down from 77% last year. In my opinion, this is a reality check. Evergreen strategies offer flexibility, but they're not immune to market pressures. What this really suggests is that advisors are becoming more selective, which is a good thing for long-term sustainability. So, what's the big takeaway here? Advisors are still bullish on alts, but they're getting smarter, more selective, and more focused on risk. From my perspective, this isn't just a shift in allocations, it's a shift in mindset. The question is, can the industry keep up with these evolving demands? And more importantly, how will this impact the average investor? Personally, I think we're just scratching the surface of what alts can do. But one thing's for sure, it's going to be a wild ride. What do you think? Are alts the future, or just another fad? Let me know in the comments below.